welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, I mentioned to Gary Boyson on Stockwatch last night that I asked him if he found the markets worrying, and he said he finds it stressful and you find it frustrating, and I think everyone is finding the volatility really, really hard to deal with. So maybe sketch out where you're at the moment.
Well, that's right. It is. It's a very, very difficult environment to navigate at the moment because it is extremely volatile. We've had the average true range on our top 40 now is sitting north of 800 points. Now, what that means is that if you look at the average daily range over the last 10-day period, it's more than 800 points in a day, which is nearly 2% movement in a day. But the thing is, a lot of people might look at that and say, well, that should be a trader's manna from heaven.
Yeah.
But the truth is, well, I certainly don't find it manna from heaven. I find it very difficult to navigate that type of market because what it also means is that if you get it wrong, you get your head absolutely chopped off. And if you get it right, of course, you can do well, but it's very, very difficult to know. And a lot of the things that have been happening on our market recently, I must be honest, it never even looked to me like these sort of things would happen. I mean, I know I said a while back we would see a bear market rally, and that sometimes these bear market rallies can be quite violent, and that certainly is what we've seen over the last couple of days. So I suppose from that perspective, yes, we suspected it was coming. But it's been very violent. It's come from the resources sector, which has been the most bombed out sector on our market. And if you'd said to me at the beginning of this year that Anglo-American was going to be up 90% and some of the gold shares would be up 200%, I don't think I would have ever thought that was a likely prospect. But here we sit, and it's happened. And if you weren't in those sectors in this market recently, that's where the money's been made on the long side. But against that, you've also got some really horrible moves that have happened on the downside. Yeah. So it's not an easy environment.
And in fact, within that, I mean, today Anglo-American is case in point. It was up 5 or 6% at one stage, and then it was down 7%. So,
yes.
And that's in the space of about 3 hours.
Anglo-American had a 17% trading range today. So it opened stronger, then it went weaker, then it went stronger, and back weaker again. The market can't make up its mind whether it wants to be up or down on that stock. What we are seeing in a lot of those resources shares, and I think it was evident with Anglo-American today, is that there's a very big short interest in a lot of those stocks. And when you've got heavy short interest like that, it does open the door for violent short squeezes. And that's why we've seen some very, very vicious moves to the upside in a number of the resources counters recently.
Yeah. Well, Garth, you have been very bearish on markets recently. And so even though we're seeing a rally, it's not one of those comfortable rallies. So you've got the chart up of the top 40 now, and maybe just talk us through that.
Yeah, well, here's the chart of the top 40. And I just want to look at this again because I know I spoke about this chart last week. And I also looked at a bunch of other charts which I said were worrying me. I looked at the VIX and said VIX was starting to edge up, and it still is. The gold price had spiked, which is an indication of a chase for safe haven assets. We've seen breakouts in utilities sectors overseas. So I spoke about all those things, and I think even last week you said I should have been wearing a bear suit, and I probably should have been. But also, be that as it may, and all of that stuff that I mentioned I think is still valid, but yet we've had this violent bear market rally. And I want to revert back to this top 40 chart that we put up here last week and just show you again. What I'd identified was that within this downtrend that we've got, and this goes back to November last year where we saw that peak, you can see there have been times where the market's consolidated in these flag-like patterns and then breaks down again. And then what I had identified last week was that we had another one of these bear flag patterns, and we were oversold on the stochastic, et cetera, et cetera. It was beginning to break to the downside to below the bottom of that flag structure. And typically, that should have gone all the way back down here to 41,300, and I was quite convinced that was going to happen. But alas, it didn't happen. And what happened, we walked in one morning, and there was a violent move to the upside. US markets had a reasonable session overnight, and all of a sudden, in 3 trading days, we get a 3,000-point rally on the top 40 index out of nowhere. Now, that is a serious bear market rally. And yeah, as I say, to me, all the technicals here were pointing for the market to move back to the prior lows. It didn't get to the prior lows. It's all of a sudden turned around and it moved very violently higher. And now we sit in a situation where we've got this downtrend from November last year, which is being challenged. Around about 44,500 on the top 40 index is where that resistance comes in. So far today, the market looks as if it's a little bit lethargic. It's suffering a bit at that area. Or when I say suffering, it seems to be struggling to be breaking much above it. But let's see what happens. Quite frankly, from here, to me, it's a 50-50 whether it goes higher or lower.
I mean, that's almost it. It's a bet. You might as well pick black or red at this point, because it's very hard to get a sense of a logical progression on the market. And I've had some snarky viewers phoning to say, oh, I could make more money betting on the horses. Well, fine, go out and bet on the horses. But Garth, I know that you want to talk about capital preservation, because it's easy with hindsight to say, oh, why didn't you pick Anglo when it rallied 18% in a day? Well, okay, if you didn't expect that to happen, if one of the basis for that happening was a short squeeze, then is the more prudent thing to do to preserve your capital?
Well, definitely. And I've always said on this show that your number one priority as a trader is to preserve your capital. Your number two priority is to try and make some money. And right now, we're in a very, very challenging market environment. And I like my cricketing analogy, so I'm going to bring out another one. The market at the moment is like facing Dale Steyn with a new ball on his best day that he's ever bowled to you. It's extremely difficult, and he's going to test your patience. He's going to try and force you to play a shot, and likelihood is if you do force a shot, you're probably going to go out. And I think for me right now, it's all about being patient, waiting. Don't feel the need to do something because we've got a TV show and we're on every week and people want to see us trade. No, we're here to promote proper trading principles. And in my mind, this kind of market is so difficult to navigate at the moment that maybe there's a way to do it. I'm not comfortable with picking trades right now in this market. I'm more erring on the side of caution, protecting capital. The opportunities will present themselves. They will. But we don't need to rush out and force trades in this kind of a market. As I said, if you get it wrong right now, you get your head absolutely chopped off. And I'm not willing to do that. So we haven't had a great start to the year yet for Traders Corner. In terms of our profitability, we're slightly down for the year. And we're a month into the year, really, considering that we started in the middle of January. We've got 10.5 months of the year left. There's still lots of time. We don't need to be doing anything stupid and forcing trades just because we feel the need to be involved at this stage.
Well, Garth, I know you also want to talk about the S&P500 index for any, I suppose, any signs of what may unfold in the market. Perhaps you've got the chart up.
Yeah, so this is quite a long-term chart of the S&P 500, and it's a theme that I've been banging on about for a while, but I like to just keep reiterating what I'm seeing here. I mean, this chart actually goes all the way back to 1996, so it's a long time ago. That was when I was still in high school, so it's been a while. But what's most interesting for me on this chart is this is a weekly graph of the S&P 500, and this blue line is a 50-week moving average. All right. Now, for me, this is a very, very interesting moving average to follow because it really very, very clearly demarcates the bull markets and the bear markets that we've seen over the last 15 years. And you can see that when your 50-week moving average starts to roll over and turn to the downside, that is a bearish signal. And nowhere in this graph ever has it turned down and then all of a sudden given you a false signal and turned back up again. When it's turned down and it's turned negative, that has been the start of a meaningful bear market. And same when it's turned at the bottom, that's turned and been the start of a meaningful bull market. Now, what do we have at the moment? We have a situation where that 50-week moving average on the S&P 500 has just rolled over. It's beginning to point south. And if I have to look at that in the context of all the previous market peaks, that certainly does worry me. And my sense is that we might get even more of a violent bear market rally from here. Maybe it goes back up and gives a throwback to test the underside of that 50-week moving average. It did it in the past. Look there in 2008. You had a nice, powerful rally. Even back in 2001, you had a bit of a rally to go and challenge the underside of that 50-week moving average before the bear market got going in earnest. But that setup to me is very, very worrying. And while that is the case, I still am of the view that we're in the early stages of a bear market and that ultimately, if this bear market does continue, then we're probably going to come down here to about 1550 on the S&P 500.
I mean, if it did rally up, what sort of percentage move might that be if it were to rally up to the underside of that 50-week
Well,
average?
I mean, it would mean a rally up to about 2,000 on the S&P. So that's 130 points from where we are at the moment. That's more than 5% rally. It's quite feasible. Bear market rallies can be very, very powerful. They can suck you in and make you feel like, okay, I need to be involved on the long side. But that's often the time when you actually sucks you in and then spits you out. So from that perspective, I'm very, very cautious as things stand.
Garth, there's been caution too as far as financial and banking stocks are concerned. on our own market and particularly on overseas markets. And you've got 2 charts of those. So why for you are they quite interesting this week?
Yeah, the banking index and the financial index for me on our market, on the JSE, actually look the most vulnerable as things stand. We've got our 3 major sectors on the JSE. So it's resources, industrials, and financials. The resources sector is extremely bombed out, and I wouldn't be that surprised this year to see the resources sector of the market begin to form a big volatile base. I do get the sense that we're probably closer to the end of the bear market in resources than in some of the other sectors. Industrials still actually look okay, but there's certainly warning signs there. But financials do look worrying to me, and I'll show you why. Now, this is also a weekly chart of the banking index. It goes back to 2007, but really what I'm focusing on here is the bull market that started in 2009. And you can see how that bull trend tied in very nicely with all the low points that we saw on this index over the last 7 years or so. Now, again, what you've got here is your 50-week moving average is beginning to turn over and point south. It's the first time it's done that in the whole of this bull market. The 50-week moving average for the banking sector has never pointed south until now. And you can see that we've got this meaningful break below the uptrend support. Right now, the bank shares are rallying, and it looks to me as if they're rallying to go and give what we call a goodbye kiss to the underside of this uptrend before another leg to the downside. So what I want to actually also show here is to zoom in on that boxed area and to show you the more recent trading action. So now this is looking at it over a 1-year period effectively, instead of that long-term graph that we were looking at a moment ago. Now here you can see basically below 6,900 on your banking index was a very, very meaningful break in November last year. We broke below that lateral support, and then of course that move was exacerbated when the finance minister was fired, and we saw pretty much a crash in the banking sector over 2 days there. The sector has been bouncing a bit, but nevertheless the technical damage has been done. And my sense is that up here, if we do see the banking index rallying back up towards 6,900, maybe 7,000 at a push, I think that it's going to really struggle to find any further drivers to take it much higher than that. And I would probably be looking to put on short positions in the banking sector up there.
And what about the broader financial index?
So the broader financial index looks very similar to the banking index, as you would expect, because the financial sector is mostly made up of the banking shares, but there are also your insurers, the Sanlams, Old Mutuals, Discoveries and of the world that are also in there. But nevertheless, the chart setup looks very, very similar. So again, you've got your uptrend from the beginning of 2009, which joins all those prior low points quite neatly, and we've broken below the bottom of that uptrend recently. Again, also your 50-week moving average for the first time in this entire bull market is now beginning to roll over and point south, which is concerning for me. It also looks quite possible that we could be making the right shoulder of a head and shoulders pattern here on the financial index. So if that were to be validated, and it would mean that we'd need to see this financial index taking out 13,500 on the downside to break the neckline of that head and shoulders, then that would project all the way down to 10,000, which is that peak that we saw in 2007. So I think it's something to monitor. It is obviously quite a bearish-looking setup. Let's see. The head and shoulders hasn't been validated yet. But broadly speaking, all of these charts, the S&P500, the bank sector, the financial sector, to me, all of them have a lot of warning signs to say, be careful. It looks as if this bull market is over, and we've now begun the onset of a new bear market in these sectors.
Okay, Garth, so given all of that, and given that you haven't put on any trades in the context of this really very hard to trade market, portfolio pretty much what it was last week?
Yeah, it's the same. We're down 1.7% for the year to date, so we're moderately negative. I'm not that bothered by it. We've got positions open at the moment. We are still short in cash build, and that I like the setup there, but I think this is a short position that we're going to probably hold on to for a while. And then we've got that option structure on the June top 40 futures, which sits in the background for us. But if we see the market breaking below 43,000, that would be quite nice in terms of that structure, because it would make us quite a lot of money.
Yeah. And then just to end off with, you have one last course coming up.
Well, for now, yeah, in this series. I've got, on the 5th of March, I'm down in Cape Town for a high probability trading course. And these courses I have tailored to be more suitable to bear market conditions. So looking for setups that allow you to make money in a bear market. So anyone that's interested in attending that, please email me, garth@traderscorner.co.za, and I'll send all the details.
Okay, Garth, that's where we leave it. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.